Thanks for coming. Forse sarebbe meglio se facessi questa presentazione in italiano. You would understand better if I did this in Italian. I was listening to the Romanian, all the Romanian speak earlier on, and it sounds so much like Italian. The first time I ever met any Romanians was in Italy in 1993, maybe 92. They were two young guys, and they had come over from Romania to Rome, or actually, was it Rome? Yes, it was Rome. I was in Tuscolano, and these two Romanian guys were there, and I met them, and they were working as construction workers. Very ambitious young guys with big dreams to make some money and go back to their country and build life for themselves. And now in 2000, I know this is a bit sentimental, but in 2017 I'm here, and it's amazing how much everything has changed, even since last time I was here. When was it, Guy? We were at 2010 or 11. Things changed pretty quickly, but I'm looking forward later to going downstairs and going to the National Museum of Art. It's a beautiful sunny day, almost Mediterranean. So anyway, I'm really glad to be here. It's a lot of fun for me to come here, and so when Guy asked if I could make it to speak at the ICAR, I jumped at the opportunity. And today, I'm a little jet lagged because I've flown over here from Chicago, where I was at PCI. PCI is like the American Baden-Baden. Not as nice, but lots of reinsurance discussions going on, although Chicago is perfectly nice. But we've been talking a lot about the reinsurance market, so I've been listening this morning, and I guess in this discussion I'm going to zoom out by about 50,000 feet, or about 10,000 meters or 15,000 meters, and talk about the reinsurance market and what's happening globally. Because 2017 is an extraordinary year in terms of global insured market losses. This is the first time, really since 2011, that we've had insured losses of this size. And I think that you can all name them, right? You've got, and a lot of them are in the States, but not all of them, because as Guy was just telling me, we were all delayed in our flights here from London last night because of Hurricane Ophelia. But before Ophelia, we had Harvey, Irma, Maria, Nate, we had the Mexican earthquakes, and it's been a big year. It looks like, and the California wildfires, it looks like when we're all said and done, it's perfectly possible that we could have over 130 billion in insured losses, which is the biggest year ever, this in inflation-adjusted terms even. So it's a big year, and there is an effect to be had on insurance and reinsurance pricing. Now, you might think, what on earth does this have to do with us here in Romania? And in fact, I was talking to a client from Norway, Muratrygt, which I know you know, and they said the same thing. Why do we have to worry about Atlantic Gulf Coast hurricanes when we're talking about Norwegian wind excess of loss cover? Well, maybe you don't. Maybe you don't. But I thought maybe it would be interesting anyway to talk about what's happening in the reinsurance market. So most of what I'm going to talk about in the next 25 minutes has to do with reinsurance. But I know we're going to have a panel about insurance penetration later, and maybe we can drill down a little bit. This first slide just shows a phenomenon which was taking place before 2017. Namely, the rate online for most classes of business in reinsurance was falling. I think that shouldn't be a surprise to anyone. Does this have a, okay, here we go. So you can see, this shouldn't, I know that this is a massive generalization, and I'm really sorry, but you've got different markets and lines of business here. And the point of this slide is that the light blue bars are farther to the left than the dark blue bars. That means that while the market was softening, the softening was becoming less pronounced every year from 2013, 14, 15 through 16. And I think maybe, I don't know, most of you should have experienced this on your programs. It was fairly favorable in terms of conditions, in terms of rates online, but the annual favorability was getting a little bit less, maybe. Right? Now, I know that everybody's experience is different. But then we had these massive catastrophes in 2017. And just for some context, I've put them up next to some of the earlier catastrophes that we've had in the world. And I'm really sorry, this presentation is going to feel really US-centric, but that's because the largest catastrophes, most of them that have ever happened, have been in the US, and they tend to affect the big reinsurers the most. So if you compare, and by the way, this is all inflation adjusted, so you can compare each of these catastrophes one to the next. They're the same dollars, if you will. Okay, there's no inflation in these charts. Look how small good old Hurricane Hugo was back in 1993. That was a big deal back then, but it was small. Roughly the size of Winter Storm Kirill in terms of the reinsured losses. And then we had Hugo was in '89, Andrew '93. The September 11th attacks, the dark blue line is the total insured loss. The light blue line is the reinsurer's portion. So September 11th, obviously Swiss Re having a big chunk of that, along with a lot of other big direct reinsurers. And then we had the big ones, Hurricane Katrina, but then Ike, and this year, these three, Harvey, Irma, and Maria. And the numbers for them are just estimates. But interestingly, Hurricane Irma is going to have a very large proportion reinsured. Maria, also large proportion reinsured, we think. We still don't have too many loss adjusters down there in Puerto Rico, but that's changing day by day. But look at Harvey. It's a relatively small proportion reinsured. And I'm actually going to, if you guys don't mind, I'm going to skip to this slide. And because we're going to talk about insurance penetration in the next segment, I think. Even these big catastrophes, many of them have a relatively small insured loss amount compared to the economic losses. Katrina, obviously much of Katrina was insured, but look at Sandy. And now we're measuring the dark blue, which is losses not covered by the private insurance market, compared to the entire stack, which is all economic losses. And if you look particularly at Harvey, look at this, 72% of the economic losses sustained in Hurricane Harvey were not insured. This is America, where, you know, we're supposed to be advanced and things in terms of our insurance penetration. Houston, America's fourth largest city, now that Detroit has gone down the tubes. Our insured loss coverage there is 28%, probably less than most Latin American countries, actually. Very low insured loss penetration. And that's because so much of Harvey was flood. We don't have a proper flood insurance program in the United States. We had the same problem with Sandy. Sandy was not very well covered in terms of insurance, and the same problem applies in different regions. If it's in Switzerland or Japan, everything is insured. But in many regions of the world, including Romania, there is a lot of uninsured loss that can happen, and that's why different pools exist. And that's a good thing, in our opinion, that loss transfer, because when we have uninsured losses, people suffer. And that's in my opinion, one of the main purposes of our sector is to protect people against loss and ruin. And that's not happening. Now, Irma, a little better. Maria, we still don't know. I wouldn't be surprised if Maria had a better insured loss coverage than Harvey, which would be embarrassing for the Texans. Okay, I'm going to rewind here and give you some more context. This is Swiss Re's chart. I've stolen it from them and modified it. So if anybody here is from Swiss Re, this is your chart, okay. I've taken it from you, and I've modified it. I've stuck what I think might be the insured loss amount for 2017 there on the end. I think it will be higher now because I think the California wildfires are going to be about 4.5–5 billion if RMS is to be believed. Tack on another billion or so, maybe 2 for Ophelia. This should be the largest loss year ever, but you can see the trend, and I guess many of you may have looked at this chart before. It too is inflation adjusted. So every single bar is comparable to the next. There's no inflation in the chart. And look at the 70s. Look at the 70s. This is when Guy was a strapping young lad, Guy Hudson. Back in the 1970s, the biggest loss year we ever had in inflation-adjusted term in 2017 dollars was 1979, and that was 16 billion. That was the biggest loss year. Back then it was probably $1 billion or something, but that was the biggest loss year ever. And we've gone from that to, I think I might be forgiven for saying losses are growing almost exponentially. What if we have a 250 billion loss year? Then I think we can say decidedly that losses are growing exponentially, but they're certainly growing more than linearly. And this, remember, this includes inflation. This is inflation adjusted. So sorry, there is no inflation on this chart, right? Why do you think that losses are getting so much bigger? Any ideas? Is it climate change? Yes. Exposure. It's so obvious, isn't it? It's not necessarily climate change. Maybe there's a little bit of that in there. We can argue about that. But the big reason is exposure. How much insured loss amount was there in Romania in 1979, right? Not as much. Not as much as now. That's for damn sure. We know that. Same thing in Florida. Same thing in Ireland. I was in Florida in 1979. It was just a bunch of guys with pickup trucks, and there were alligators and people living in cabins in the Everglades. Now it's hotels, it's everything. And same thing with Ireland, and I think same thing with Romania. It's changed so much. So we talk about the need to increase insurance penetration. Well, it has already increased, but being a reinsurance broker, of course I would say this, it needs to increase even more. We need to cover the risks of people and companies in the private market, I think, in as much as we possibly can. This is the JLT Re Global Property Catastrophe Reinsurance Risk-Adjusted Rate Online Index. It is the world's most long-running index of risk-adjusted rates online. When I say risk-adjusted, again, I mean every point on the graph is comparable to the next. That's because in the rate online calculation here for the index, we're adjusting the denominator. We're adjusting the exposures. And you can see that trend. This is global, by the way. This is everywhere. So this is Australia, Japan, India, Romania, Ireland, the UK, the US, Latin America, even Canada. We decided to let the Canadians into this chart as well. It shows everything. And you can see that trend that I was talking about before. But look what happened after September 11th and Katrina. Does everybody remember that? When reinsurance rates just skyrocketed? I can tell you I was in Chicago, gosh, yesterday? I was in Chicago yesterday or the day before yesterday, and the reinsurers there, they're pounding the table. They want to see rates online do that again. They want a hard market, right? Of course they do. They're reinsurers, right? I'm sorry, I know there's reinsurers in the room, but they want to see the market harden. But will it harden? Will it harden that much? I don't know. Nobody knows until January 1st, right? You can see that before this, as I was saying, the rates were declining, but the rate of decline was also declining. The first derivative was negative for you mathematicians here in the room. Will this index go up 10%? Will it go up 5%? Retrocession underwriters are hoping that it will go up 50% for them. In retro, I think I've been penciling in 20 to 30 for retro, 5 to 10 for global reinsurance property cat rates online, but I could be wrong. I'm sure I'm wrong for Romania. But that's the situation that we're in. Now, if we look at last time we had a hard market, we had the dot-com bust, we had September 11th, we had the liability crisis, we had Hurricanes Charlie, Ivan, Jean, Katrina, Rita, Wilma, we had the rating agencies go through an existential crisis a couple of years later. The market was very hard because of that coalescence of events. Do we have that now? Actually, what we have now is a lot of capital in the reinsurance sector globally. We think that the sector is overcapitalized by about 60 billion US dollars right now, or it was before the hurricanes. $60 billion. Now, if you go back into the early 2000s, you can see that, and I'm sorry, I should explain this chart. The bars are the dedicated capital of the reinsurance sector as we at JLT Re carefully measure it. The line, again, stolen from Swiss Re, sorry, is the global reinsurance gross premium, including life reinsurance. So it's all reinsurance premium everywhere in the world. Why do we use these big numbers? Because they're the only ones we can really measure very precisely by stealing them from Swiss Re. So the point is that back in the early 2000s and late 90s, the reinsurance sector had a solvency margin, that's capital divided by premiums, of about 80%, which we think is about right for all lines, P&C, life, specialty, everything. Now we have a solvency margin ratio going into the 2017 year of 128%. We have so much capital. Why do we have all this capital? I've given you a hint because this is showing you the alternative capital proportion, the third-party capital that has come into the sector, and I've broken it out for 15, 16, and the first half of 17 before the hurricanes. So we know that third-party capital has come in, but just rated capital has grown a lot. Why is that? Why has that reinsurance capital grown so much? One reason is that interest rates have been coming down over this period, and as interest rates fall, asset prices usually rise, and that is beneficial to reinsurers' balance sheets. But the point is there's a lot of supply, and there has not been as much demand. Premiums, as you can see here, have stayed relatively static over the period, and that's why we've seen prices fall. It's pretty straightforward. If you have more supply than demand, prices are going to fall. This is Econ 101. This is what's been happening. We've all been able to use this to explain what has happened. But now, for the first time in 6 years, we're in a very dynamic renewal environment. Monte Carlo this year, I think everybody will agree, was quite different than it has been for the last 4 years. I think Baden-Baden will be a different conversation this year than it has been. And PCI certainly was. I can tell you, I had a big reinsurance company, not Swiss Re, arguing with me about rates, and they were gunning for huge increases, and I was saying, oh, come on, that's really high. But that's what people are saying for global covers, for national covers in a lot of countries this year. Okay, I wanted to show you this chart because we are trying to analyze, okay, then what really happens if we take that argument that I just made about supply and demand, what actually happens in years where we have excess supply. And in fact, there's a pretty strong correlation. Where there's excess capital, and this is the excess capital ratio, the amount, the percentage of excess capital above the required amount, according to JLT Re, okay, so this is our estimate. Where there's excess capital in years like 2009 to 2017, prices move around a little bit, but they tend to start falling. There's an inverse correlation. Where there's deficient capital, where you're at a solvency margin ratio less than 100, prices tend to rise. Now, are we going to be at a solvency margin ratio less than 100 after all these hurricanes? Well, I don't know. Let's think about it. We've got, let's say, $325 billion of dedicated capital. Let's just be aggressive and say that we have $130 billion of insured losses. And let's be aggressive again and say that half of those are reinsured. So we've got $65 billion of reinsured losses. You add in the $22 billion or so of cat premiums, which come in every year. Net that off the 65, it gets you to 43. So can anybody do math faster than me? 325 minus 43, 282, right? 282. This is so simplistic. Okay, this is so simplistic. But going back to this chart, 282. I'm not doing this very well, but it seems like we're still going to have a little bit of excess capital when this is all over with. I don't know. So that's important. Now, you've also got third-party capital coming in. You have second event funds coming in. You do have some trapped collateral out there, which just means that there is collateral that must be set aside when part of the deductible is exhausted, and we have to wait for that to change. But it's been a record cat bond issuance this year in the ILS market. We've had the largest issuance ever in 2017. That surprised me. The last record year was 2014. Cat bond issuance had been falling since then. We've even had issuances in the third quarter after the hurricanes. So the cat bond market seems healthy. There used to be an argument that went on, and maybe there still is, about third-party capital, collateralized reinsurance, and ILS cover in the markets, which went like this. People would say, well, the cat bond market has never really been tested. It's never really been tested. When it gets tested, we'll see that some of the money will go. I don't think that's happening yet. I don't think it's happening yet. If anything, we're seeing second event funds coming in and trying to issue more ILS. The secondary level outstanding is higher than ever. We even have collateralized players and rated carriers trying to put together more capacity. We had Hiscox request more capacity from Lloyd's. That was a pretty gutsy thing for them to do, I thought. But it doesn't seem like the capital is shy right now. It doesn't seem like the capital is afraid to come in, even though we know this is probably the biggest cat loss year ever. What are the implications of that? Capital is still coming in rapidly to take advantage of that maybe spike that we're going to get in rates online globally or yields globally. I think that's significant. I think that's different from what some people may have expected in a $130 billion cat loss year. But we'll see. We'll see. We still don't know exactly what's going to happen, and the year isn't over yet. This is another argument that we have, though. A lot of people think that third-party capital is eventually just going to take over the reinsurance market. And a couple of our competitors, and McKinsey, who I always like slagging off, have said in the past that by 2020, 40% of all property catastrophe reinsurance limit will be provided by third-party capital. When they said that, we at JLT Re said, actually, that's too aggressive. We think that it's more like somewhere around 25%, maybe 30% by the early 2020s. Right now, we think there's about $80 billion of third-party limit in the property cat space of 380, which gets us to 22%. So we're starting to feel vindicated, although it's early days. We don't think third-party capital is just going to take over the whole market. We think it's going to stay, it's not going to leave, but it's not going to take over either. We think it looks like the entry of third-party capital into the market and the absolute amount of third-party capital will look like an S-curve rather than a straight line. If anybody disagrees with me, you are free to say so. I'm hoping that some of you will. Get me after the conference and we can discuss it. These are open questions, many of them. Okay, finally, this just shows what happens when the annual change of insured losses is positive or negative, the bars, versus the cost of reinsurance globally, the line. And again here, there's something of a correlation. When the change in insured losses is very much negative, as it was in 2006, rates tend to go down. When it's positive, rates tend to go up, although that wasn't the case recently. It was the case in 2011, but to a much lesser extent. We had more capital. We have to also remember something that I haven't pointed out, and I'm sorry to keep rewinding, but something that I haven't pointed out is that, of course, am I going to fall off? I better be careful. Of course, reinsurance property catastrophe rates online globally on a risk-adjusted basis are really quite low right now compared to the long-term trend. We're now quite sure that 1999 and 2000 was too low. So how much lower can they go? And that factors into our discussion here, of what's going to happen on January 1st, right? What's going to happen globally on January 1st? Well, we're coming off of a low base. We're going to see a lot bigger catastrophes, but we have a lot of excess capital going into this. So there are different competing factors which are going to influence the renewal on the one hand and on the other hand, right? I'm going to be anxious to hear your views after this. One other thing that I should show you, which is really important, and I think my reinsurance friends here will agree with this, and I think that my insurance underwriting friends will agree with this too. It's getting very difficult now to make money in the reinsurance business. The return hurdles for reinsurers in most cases are higher than what reinsurers are expected to earn. So this chart simply shows you the top 20 global listed P&C reinsurers, right? And it shows you the return on invested capital, the anticipated return on invested capital minus the weighted average cost of capital. What's that? That's just like saying, how much do we think we're going to make minus how much does it cost us to get the capital that we need to make that return. And that measure is known as economic value added, EVA. The EVA for 2/3 of reinsurers on a forward basis is negative. Okay, so what does that mean? That means that the stock market, and we all know the stock market can be terribly wrong sometimes, but right now the stock market is telling 2/3 of listed reinsurers that they should either get bought or go into runoff. That's what the market's telling us. Again, the market has been wrong before, notably, right? But nevertheless, that's what this shows. It's pretty tough if you think you're going to make a 7% return on equity in 2019 or 18 if your cost of capital is 8%. And that's where the reinsurers are. Had you looked at this exact same chart last year, it would have been about half and half. Had you looked at this chart in 2012, 2013, most reinsurers would have been earning their cost of capital. But now, most reinsurers are not earning their costs of capital. So there again, they will definitely want to do something about that because it will be felt. Rates online are too low to sustain costs of operating, right? Okay, so that's why it's relevant to us to some extent, these Atlantic hurricanes over in America, which, you know, the reinsurance sector was set up in large part to deal with Atlantic hurricanes, okay? But that's why these Atlantic hurricanes are of some import to us here in Romania and in Norway and in Japan and places where there were no hurricanes and where there were no catastrophes. It affects the bulk of the people who are providing the reinsurance cover. Now, this is a discussion that you will all have to have with your reinsurers at renewal, but these are some of the background factors that they'll be talking about. Okay. globally, something that was just terrible for brokers like Guy and myself, people stopped buying reinsurance in a big way between 2011 and 2014. Reinsurance cessions, ceded reinsurance, premiums that were ceded divided by gross premiums, the cession rate, fell from a temporary high in 2012 to something like an all-time low in 2014. And that was because the big guys, and I will name you, the Generalis, the Allianzes, the Zurichs, the AIGs, the Travelers, the Tokyo Marines, the big global P&C companies, they made it a point to consolidate their spend. They wanted to consolidate their reinsurance purchase. They closed the Buenos Aires reinsurance buying office and brought it back to Trieste. That's not a real example. I'm just making that up, but you get the point. And they centralized reinsurance purchasing, and they used their own capital, which they thought was cheaper than reinsurance at the time, and the cession rate fell. And poor Guy and myself, we would just go down to the pub and have a pint of Guinness and cry tears of regret because nobody was buying as much as they used to. But something happened in 2015 and 16. And again, these are very high level numbers. The reason they're so high level is because that's the only way that I can measure them accurately. People began to buy more. People began to cede more. We saw this particularly at the June 1st renewal this year in Florida, when it was a late renewal, and because it was a late renewal, people came in at the very last week and bought a lot more limit because it was a good deal, or they thought it was. Reinsurance has now been seen for the last couple of years as an increasingly competitive form of contingent capital. Globally, insurers have been buying more reinsurance, and we hope that trend will continue on January 1st. But that will depend on the price, I think, right? For you buyers in the room. This is also happening, though. Reinsurance is more in demand than it used to be, even though we still have a lot of supply. Okay, so I think that's the most of the spiel on the reinsurance market. But before I close, I just wanted to show you this quite horrid chart, which is the big elephant in the room that we always forget to talk about, which is reserving. According to AM Best, 60% of all P&C insurer failures from 1969 to 2016 happened because of deficient reserves or too rapid growth, which is really just deficient reserving by another name, right? So this is actually the biggest deal in the sector. And if I'm sorry to keep flipping around, I know I've been doing this the whole time, but if you look at this rise in rates, people say, oh, it was September 11th. Oh, it was Hurricane Katrina. Okay, oh no, it was Charlie, Ivan, and Gene. It was the dot-com bust. What was it? It was reserves. It was, and I'm sorry if I'm going to offend anybody here, I probably will, Convarium, Gerling Global, Rayak, Trenwick. It was the Independent. It was everybody, so don't feel bad. It was Royal Indemnity. It was American Re. It was Lloyd's. Everybody had deficient reserves back then. I remember I was working at Merrill Lynch. We had Convarium on buy. We were told by the management that the reserves were fine. And then they had, I think it must have been their third quarter call in 2004, and they had to mark up reserves very significantly. That was very bad. And it wasn't just Convarium that was doing it. It was everybody, SCORE as well. Everybody was increasing reserves. Hell, even Munich Re had a big reserves increase with American Re, right? That scared everybody. And we talk about, $130 billion loss year. We think that the liability crisis probably cost us upwards of $300 billion over the period in which it took place. So I'm just making the point to you that reserving is actually probably a much bigger deal than all these catastrophes that I've been talking about this whole time. So what does this chart show? This chart shows and the evolution of the reserving cycle for the top 30 global P&C carriers since 1998. And we're looking at it both on an accident year and a calendar year basis. Now the dots represent calendar year quarterly reserve development as reported. So this is just to give you some idea of the work that went into this chart. Behind every one of those dots, we've looked at all 30 P&C companies, every single 10K, 10Q, IFRS annual statement, press release, presentation, conference call transcript, everything we can find to try to determine what reserves were released that quarter, what reserves were deficient that quarter. And you can see that the last time we had a danger phase was in the 2000s. During this period, in the 2000s, we can now see manifestly that companies were releasing reserves externally at the same time that their loss picks were too low internally. Accident year, the line subsequently developed adversely. So this gap, that's what VJ Dowling calls the cheating phase. We've called it the danger phase because we don't want to upset any of our clients, but it's really the cheating phase. That's when you tell everybody that everything's fine, but internally you know that it's not going great. And the consequence to that is everything had to be strengthened. Everything had to be strengthened. This is the liability crisis. These blue dots depleted the sector's capital significantly. And then the accident year loss ratio became much more conservative and much more redundant. And really, ever since 2006, we've had only redundancies in aggregate. The whole sector has been redundant every single quarter. Tohoku Fukushima, New Zealand earthquakes, financial crisis, Sandy, reserve releases. It's okay. Our combined ratio is still okay because reserve releases. And that's been great. We've been able to make it through an extraordinarily tough period as pricing has been falling because of reserve releases. In the fourth quarter of 2016, for the first time since the third quarter of 2005, these top 30 companies had, for the first time in over 10 years, a net deficiency. And that was largely due to one transaction, and I think most of you will know what that was. But you can see that the redundancies are starting to abate. There's probably no point in paying too much attention to this part of the orange line because the accident year hasn't really developed yet. But it's perfectly conceivable that in 5 years we'll be looking at this chart. The yellow line will be above the line and we'll have some blue dots above the line, and we will say, 2015, 14, 16, that was the cheating phase. It's perfectly conceivable. Now, health warning, I've been saying this for about the last 8 years, so I've been wrong for a long time, but it looks like we're finally going to be right, and we're going to get some reserve strengthening in the next few years. In fact, I can say for sure that since I've joined JLT, we've had far more discussions about loss portfolio transfers, adverse development covers, structured reserve protection products than I ever had during my 7 years at Carpenter. And I don't think that's because JLT Re does more of these deals than Carpenter. I think on the contrary, we probably do less. I think it's because the market's changing. People need these reserve covers and people need that protection. And the other thing that I'll just close on is that if reserves are actually deficient, then do we really believe that we're overcapitalized if reserves are deficient? Because after all, in the insurance business, capital is just a guess. It's an educated guess, but it's just a guess. So on that dreary note, I'll finish, and with the assurance that later I'll be outside in the Bucharest sun. Thank you very much.
Well, thank you too. I have a confession to make, especially to the public, more than to you. It is due to the fact that, as far as I remember, we haven't had such a comprehensive and fully touching all the aspects, although it's only at the global numbers level, because that's where you can precisely measure, and only there. So this is why you have had such a long time to do your presentation. We do hope to have you back within 20 minutes of presentations starting from next time on. Any questions, comments from the room? David, thank you anyway. This was great.
My pleasure.
Daniela?
Can I have a question?
Yeah.
Well, I was wondering, you said that in 2015-16, people actually started to buy more insurance. How much do you think this had to do with the changing regulatory regime in Europe, especially the Solvency II, the new capital requirements, and so on and so forth?
I think that there was a marginal effect from Solvency II. I do. I remember in 2013 meeting with my former boss, who was an equity analyst, and he was anticipating that because of Solvency II there would be tens of billions of new reinsurance purchase in Europe. It wasn't anything like that. It wasn't anything like that, but for sure the fact that capital requirements were higher for people who had previously been reporting under Solvency I will have had an effect on that. That's a great point. So I mainly talked about the big global guys who were consolidating their purchases, but some of the medium-sized companies who had been previously reporting under Solvency I, yes, in our experience, they did purchase more, but it was always at the margins. It was always kind of, and people correct me if I'm wrong, but for us it was always people tidying up a little bit their PMLs, tidying up their economic capital, and making sure that they met the obligations of Solvency II. Part of that was because for anybody who was rated, who had a rating from Standard & Poor's, they were already quite well capitalized as regarded the SCR. But yes, I'm sure that had an effect, and I'm sure that I haven't called that out properly on this chart. So thank you. I'll look into that.
Yeah, thank you very much.
You're welcome.
Well, the second thing, I just am curious if you have an educated guess, as you said. As far as I understand, prices are now as low as they can get.
Okay.
And probably rather sooner than later we will see some prices going up. But I expect it will have also to do with the region.
Yeah, of course.
Of the risk.
Yes.
So in Europe in particular, and in the Eastern Europe, where losses are obviously very low,
Yes.
as compared to anything.
Yes.
What should we expect?
Well, that's a great point. And our CEO of EMEA, Keith Harrison, he always says to me, David, he goes, this doesn't have very much to do with Romania or Poland or France or Norway. And he's right, because these are the big global trends that are at 50,000 feet. But more important regionally are the regional trends. What is the quake risk? What are the recent losses? And crucially, this is important too, how much of a diversifying credit is Romania for the reinsurer in spite of losses, right? Romanian losses are uncorrelated to a lot of big peak risks like Atlantic hurricanes or California quake or Japanese quake, which are the big ones that affect reinsurers. And Romania has uncorrelated risk, it has relatively low risk, so those factors should play just as big a part. But the overlay is the macroeconomic picture. But usually the regional picture has just as great, if not greater, effect on pricing. So that's really important.